So a corporate balance sheet is supposed to be, well, an exercise in simple, comforting math.
Right, it's usually pretty straightforward.
Exactly. You add up your assets on the left side, you subtract your liabilities on the right, and whatever is left over is just the reality of your business.
It's binary.
Yeah. You're either solvent or you're insolvent. You are cash rich or you're distressed. The spreadsheet isn't supposed to have an opinion, and it definitely isn't supposed to contradict itself.
But then you look at EchoStar's Q2 2026 ledger, and that mathematical reality just completely fractures.
It really does.
You're looking at a financial document that feels more like a psychological thriller than a standard quarterly filing.
And that is exactly why we're doing this deep dive into the source material today. Because what happened on the morning of this earnings call is, well, it's the equivalent of a billionaire casually watching his luxury yacht get repossessed by the bank.
Yeah, just letting them take it.
Right. Simply because he didn't feel like texting his accountant to transfer the funds to pay the mortgage. And he's doing this while sitting on a literal mountain of cash.
$14 to $15 billion in cash, to be exact.
It's insane.
And yet, on the very morning they announced that massive liquidity cushion to Wall Street, EchoStar deliberately sent one of their main subsidiaries, the Hughes Corporation, into Chapter 11 bankruptcy.
Over a $1.5 billion debt maturity. I mean, it makes absolutely no sense on the surface.
No, it really doesn't.
And so that's our mission for this deep dive. We are looking at a high-stakes, basically unscripted Q&A session with EchoStar's chairman, Charlie Ergen, and his whole executive team.
Yeah, it was quite the call.
We're going to rip apart the Wall Street jargon, the bizarre legal maneuverings, and these totally contradictory numbers. We have to figure out what this all actually means for you, the retail investor who is holding or maybe considering EchoStar stock.
We need to figure out if this is a distressed asset that's about to collapse or, wildly undervalued treasure chest.
Exactly. So to answer that, we really have to throw away traditional financial metrics, don't we?
Oh, totally. If you're looking at their standard earnings per share, or if you're trying to model out incremental revenue growth from their satellite TV business, you are just looking in the wrong place entirely.
Right. Because that's not the real story.
The entire story of this company right now is locked inside the extreme architecture of their capital structure.
So let's start pulling apart that structure. Let's look at the headline numbers Ergen threw out on this call, because they are just staggering.
They really are.
We already mentioned the cash. Ergen casually notes that looking at the total company umbrella, they're sitting on roughly $14 billion to $15 billion in cash on hand.
Which, in the current macroeconomic environment of 2026, where the cost of capital is incredibly high.
Oh, it's brutal right now.
Yeah, and many legacy telecom companies are totally starved for liquidity. Yeah. Having that much cash is almost an offensive amount of money to be hoarding.
It really gives them a defensive moat that very few companies in, any sector possess right now, let alone telecom.
Exactly.
And it's not just cash. Let's talk about the equity portfolio, specifically SpaceX. Ergen confirmed on the call that EchoStar holds exactly 261.8 million shares of SpaceX.
That's a massive stake.
But SpaceX is a private company, right? So it doesn't trade on the New York Stock Exchange where we can just look up the ticker and see the daily price. How do we even begin to value a stake like that?
Well, you have to look at the secondary markets and the periodic funding rounds that SpaceX conducts.
Right.
During the call, one of the analysts referenced a previous valuation benchmark for SpaceX at around $400 billion.
Wow.
Now, whether that implied valuation holds up perfectly in a liquid market is, a debate for the analysts. But just run the rough math on 261.8 million shares against a multi-hundred billion dollar corporate valuation.
It's astronomical. The implied value of that single line item on EchoStar's balance sheet is just off the charts.
It's the kind of asset that completely warps the gravity of a normal balance sheet.
Yeah, if they ever liquidated that, it would fundamentally change the company. But before we get to the tax nightmare of actually trying to sell those shares, we need to balance the ledger.
Right. We have to look at the liabilities.
Because we have the $15 billion in cash and the massive SpaceX equity. But what about the debt? Legacy telecom is notorious for carrying a ton of debt to build out cell towers and launch satellites.
Sure, but Ergen outlined a debt profile that is surprisingly manageable, assuming you exclude the Hughes subsidiary, which, we'll get to in a second.
Right.
He mentioned about $5 billion in standard corporate debt. Then he highlighted another chunk of almost $8 billion in debt that is directly tied to the SpaceX transaction.
But that $8 billion is slated to be paid off automatically at the closing of that deal, right?
Exactly. It essentially cancels itself out once the paperwork is signed.
So it's a liability, but it's a liability with a built-in kill switch.
Yep. And finally, he noted $1.9 billion in convertible debt that is currently in the money and expected to convert.
Okay, wait, stop right there. Because convertible debt and in the money are terms that get thrown around a lot on these calls, but I want to make sure the mechanics are crystal clear for the listener.
Of course.
So if I buy a standard corporate bond, I'm lending the company money, and they promise to pay me back my principal plus interest on a specific date. How is convertible debt different? And why does it matter that it's in the money?
So a convertible bond is basically a hybrid financial instrument. It starts its life as a loan. It pays interest and has a maturity date just like a normal bond.
Okay, making sense so far.
But it comes with a special option attached for the person who holds the bond. They have the right, under certain conditions, to convert that debt into a specific number of shares of the company's common stock instead of getting their cash back.
Wait, why would a bondholder want shares instead of just getting their cash back?
Because of the stock price.
Yeah.
Every convertible bond has a strike price or conversion price baked into the contract. So let's say a company issues a convertible bond with a conversion price of $10 per share. If the company's stock is currently trading at $5, the bondholder obviously doesn't want the stock.
Yeah, that would be a terrible deal.
Exactly. They'll just hold the bond, collect the interest, and demand their cash back at maturity. In that scenario, the debt is out of the money.
But if the stock skyrockets to, say, $20 a share,
then the bond is in the money. The bondholder can exercise their right to convert the debt into shares at that $10 price and then instantly turn around and sell those shares on the open market for $20.
Oh, wow. So they make a massive profit.
Exactly. So when Ergen says the $1.9 billion in convertible debt is in the money and expected to convert, he is telling the market, hey, do not expect me to write a $1.9 billion check from our cash reserves.
Because they're just going to take the stock instead.
Right.
Which saves the company $1.9 billion in cash, but, and correct me if I'm wrong, it dilutes the existing shareholders because new shares are magically printed and handed to the bondholders.
That is correct. It's a trade-off. But from a pure corporate liquidity standpoint, it means that $1.9 billion is not a threat to their cash pile.
So when you net all of this out, the $15 billion in cash, the $8 billion being wiped out by the SpaceX close, and the $1.9 billion converting to equity EchoStar is sitting on a fortress balance sheet.
They are incredibly cash rich with highly manageable debt at the parent company level.
And as if to underline that exact point, the board of directors announced on the call that they increased their Stark buyback authorization to a massive $5 billion.
Which is a classic signaling mechanism. It's management pointing a neon sign at the market saying, look, we have so much money that we could theoretically buy up a massive portion of our own company if we wanted to.
But hold on, because this is where the spreadsheet completely breaks down. This is where the psychology comes in.
Oh yeah, here we go.
They have $15 billion in cash. They have manageable parent company debt. They are authorizing $5 billion for stock buybacks. They look financially bulletproof. And yet, on the very morning of this earnings call, Hughes Corporation, a subsidiary they own, filed for Chapter 11 bankruptcy because they missed a $1.5 billion debt maturity due on August 1st.
The audacity of the timing is just genuinely remarkable.
I cannot wrap my head around it. How does a bankruptcy judge not look at the parent company's $15 billion bank account and immediately force them to pay the $1.5 billion?
Well,
because, I mean, isn't it all the same company? If I default on my car loan, I can't just tell the bank, oh, my right pocket is bankrupt, but my left pocket has $10,000 and you aren't allowed to touch it. They would just take the money.
They absolutely would. But corporate law in the United States, particularly Delaware corporate law, treats subsidiaries as distinctly separate legal persons.
Okay.
This is the magic and, some would argue the ruthlessness of a concept called ring fencing. Ergen was meticulous in his opening remarks to establish this firewall.
He really was.
He stated explicitly that this Chapter 11 filing is strictly limited to the Hughes entities. It does not include EchoStar Corporation. It does not include the non-Hughes subsidiaries. It doesn't even pull in the Hughes international entities.
So they essentially built a watertight bulkhead on a sinking ship, shoved the $1.5 billion debt into that one specific room, and just locked the door.
That is exactly what they did. When those bondholders lent that $1.5 billion, the contract they signed was with the Hughes entity, not with EchoStar, the parent company.
Right.
So unless EchoStar explicitly signed a guarantee to backstop that specific debt, which they clearly didn't, or they structured it so it expired, the bondholders have zero legal claim to the parent company's $15 billion treasure chest.
But surely the bondholders knew this was a possibility, right? They knew they were lending money to a subsidiary.
They did, but they were likely betting that Charlie Ergen wouldn't want the public relations nightmare of a messy bankruptcy headline on the morning of an earnings call.
So it was a game of chicken.
Exactly. The bondholders likely assumed, well, EchoStar has $15 billion. If we play hardball on renegotiating this $1.5 billion maturity, they'll eventually cave and just write a check from the parent company to make the problem go away quietly.
Yeah, but Charlie Ergen doesn't care about a messy headline.
He fundamentally does not care. From his perspective as a capital allocator, taking $1.5 billion of EchoStar's pristine cash and handing it to bondholders at par value, meaning 100 cents on the dollar, to bail out a struggling subsidiary is just a terrible, inefficient use of capital.
He'd rather take the PR hit.
Oh, 100%. He would rather endure the legal headache, the lawyer fees, and the ugly optics of a Chapter 11 filing than surrender that liquidity.
He essentially looked at the bondholders and said, you lent money to Hughes. Hughes can't pay you. I have $15 billion right here in my pocket, but you can't touch a dime of it. I will see you in bankruptcy court.
Precisely. And in bankruptcy court, Hughes actually has leverage. Ergen confirmed they filed first day motions, which is super standard in Chapter 11.
Right, just to keep the lights on.
Exactly. These motions ask the judge for permission to keep paying employees, keep serving customers, and keep paying critical vendors so the underlying business doesn't just evaporate.
Because Chapter 11 isn't a liquidation, it's a reorganization.
Yes. The business keeps running while the judge forces the bondholders to the negotiating table. The bondholders will likely have to accept a haircut. Maybe they get 60 cents on the dollar, or maybe their debt gets converted into equity in the newly restructured Hughes entity.
But the core takeaway here for you, the retail investor holding the Echo ticker, is that you shouldn't see the word bankruptcy flashing on CNBC and panic sell your stock, assuming the entire company is going to zero.
Absolutely not. This is a tactical, localized, weaponized bankruptcy.
Yeah.
It's designed to protect the broader enterprise value by containing a toxic asset.
Okay, so that explains the paradox of the headline numbers. But Ergen isn't hoarding $15 billion and playing legal games with bankruptcy courts just for the fun of it.
No, definitely not.
These extreme defensive maneuvers are the result of severe operational crises and massive structural pivots that are happening right beneath the surface. So let's get into the story behind the numbers. Ergen has $15 billion, but he's ruthlessly protecting it by throwing Hughes to the wolves.
Yeah.
That begs the question. What is he so terrified of paying for that he's hoarding this much cash? And the answer lies in a massive multi-billion-dollar mandate from the United States government.
This is where we uncover the operational reality that is forcing this aggressive balance sheet defense. The cash isn't a luxury for them, it's a war chest for a series of impending financial disasters.
So let's start with the darkest cloud hanging over the company. During the Q&A, analyst Brent Penter brought up the SpaceX transactions. We already established that those 261.8 million shares of SpaceX are incredibly valuable.
Super valuable.
But Ergen dropped a bombshell. He stated that the company is facing a liability in the range of $5 billion to $7 billion related to this.
$5 to $7 billion is a staggering liability range. And it is vital we unpack exactly what makes up that figure, because it's not a simple calculation. It is a crazy collision of corporate tax law and federal regulatory enforcement.
Ergen clarified that this massive $5 to $7 billion figure covers two distinct but mathematically intertwined problems: the tax liability from the massive appreciation of the SpaceX shares and the physical cost of finalizing the termination of their wireless network, which is a shutdown mandated by the FCC.
It is so rare to see a corporate executive bundle a capital gains tax problem with an infrastructure demolition project, but in EchoStar's current legal framework, they are totally linked.
Let's talk about the FCC side first. Why is the government forcing a telecommunications company to shut down its own wireless network? I mean, don't we generally want more networks?
We do, but the telecom industry is highly regulated, specifically regarding spectrum, which is the radio frequencies that carry data through the air. The FCC grants licenses for companies to use specific bands of spectrum. But those licenses come with strict rules to prevent monopolies and ensure the spectrum is actually utilized for the public good.
So if a company merges or changes the fundamental nature of its business.
Exactly. The FCC often mandates that certain legacy networks must be decommissioned by a specific date to free up spectrum or prevent anti-competitive overlap.
So EchoStar is legally on the hook to tear down physical infrastructure. They have to break leases, dismantle towers, and migrate customers off a dying network.
Yep.
And that costs an absolute fortune.
It does. Ergen noted that they've already set aside a $2.4 billion escrow account, which was funded by the cash they received from closing a separate transaction with AT&T.
Wow.
That $2.4 billion is sitting in a lockbox, specifically earmarked for dealing with the network shutdown and the related legal headaches. So right off the bat, $2.4 billion of their cash pile is completely spoken for.
Okay, so that covers the physical shutdown. But when analyst Michael Abate-Marco asked for clarification on whether that $5 to $7 billion total liability figure also included the massive tax bill they're going to owe on the SpaceX shares, Ergen said yes.
He did.
But he didn't just say they were going to write a check to the IRS. He casually dropped a phrase, assuming everyone on the call knew exactly what it meant. He said they're looking into 1033 exchanges.
Oh, yeah.
I need you to break this down because I consider myself fairly financially literate and I literally had to look this up. What exactly is a Section 1033 exchange and how does it relate to shutting down a cell tower and owning stock in a rocket company?
It is one of the most complex and fascinating maneuvers in corporate tax strategy. Section 293 of the U.S. Internal Revenue Code deals with what the IRS calls involuntary conversions.
Involuntary conversions, meaning you didn't choose to sell the asset, someone forced your hand.
Exactly. The classic textbook example of a 1033 exchange involves eminent domain. Imagine you own a massive farm that has been in your family for generations. You bought the land for $100,000, and today it's worth $10 million.
Okay, nice problem to have.
Right, and you have no intention of selling it. But suddenly, the state government decides they need to build a new interstate highway right through your living room. They use eminent domain, force you to sell the land to them, and hand you a check for $10 million.
Which means I suddenly have a $9.9 million capital gain, and the IRS is going to demand millions in taxes for a sale I didn't even want to make in the first place.
Right. And the tax code recognizes that this is unfair. So Section 133 provides a loophole. It says that if you experience an involuntary conversion, like a government seizure, you can defer paying all of those capital gains taxes, provided you take that $10 million and reinvest it into similar or related property within a specific legal time frame.
Ah, I see.
So if you buy another farm, you don't pay the tax until you eventually sell the new farm voluntarily.
Okay, I understand the farm analogy perfectly. Now apply that to EchoStar. How are they claiming an involuntary conversion here?
EchoStar is arguing that the FCC, the government, is explicitly mandating the shutdown of their legacy network. The government is forcing them to alter their asset base, destroying the value of that specific infrastructure.
Right.
While the exact legal mechanics of how their high-priced lawyers are tying the massive capital gains from the SpaceX equity to the government-mandated network shutdown is, highly proprietary, the strategic principle is super clear.
Ergen is basically signaling that they're attempting to use the FCC's aggressive regulatory mandate against the IRS.
Precisely. They are trying to argue that because the government is forcing them to lose money shutting down the network, they should be allowed to use a 1033 exchange to shield the massive windfall profits they're sitting on from the SpaceX stock.
It is an aggressive, highly complex tax deferral strategy. But here's the risk for you, the retail investor. When Ergen says the total liability is $5 to $7 billion, he's baking in the assumption that his lawyers and accountants are going to successfully execute these complex maneuvers.
Exactly. And if the IRS challenges the 1033 exchange in court and wins, or what if SpaceX's private market valuation skyrockets to $600 billion before the transaction fully closes, which would vastly increase the capital gains exposure?
Then that $5 to $7 billion liability could swing wildly upward.
It absolutely could. Ergen specifically cautioned the analysts that the final number could be a little higher or a little lower depending on future litigation and private market valuations.
The takeaway here is that EchoStar is navigating an absolute minefield of tax and regulatory liabilities. They aren't hoarding $15 billion out of greed. They are holding it because they could legitimately face a multi-billion-dollar bill from the federal government at literally any moment.
Which is terrifying.
It really is. And it brings us to their next massive operational headache, which is entirely self-inflicted. Boost Mobile.
Oh boy.
Yeah, Charlie Ergen was incredibly candid on this call about Boost Mobile, arguably to a fault. When he was asked about the strategic direction of it, he didn't use the typical CEO spin. He explicitly admitted, and I quote, "We haven't cracked the code on how to be successful in the wireless business."
That level of bluntness on a public earnings call is incredibly rare.
It was shocking.
Usually, if a division is failing, management will talk about temporary macroeconomic headwinds or transitional phases. They try to obscure the failure with jargon. Ergen just flat out looked at Wall Street and said, "We haven't figured it out."
He actually went further than that. He said they have essentially treaded water for 4 years now. He noted that while Boost Mobile was slightly cash positive in the second quarter, they actually lost subscribers overall.
Ouch.
Let's be real for a second. If I am a retail investor and I hear the chairman of the company say they've treaded water for 4 years in a highly competitive sector like retail wireless, alarm bells are ringing in my head.
As they should be. Retail wireless is a brutal, low-margin business. You are competing against giants like Verizon, AT&T, and T-Mobile, who have massive marketing budgets and actually own the underlying physical networks. Boost Mobile operates largely as an MVNO, a mobile virtual network operator.
Break that down real quick. What does an MVNO actually do?
Think of it like renting an apartment and subleasing the rooms. Boost Mobile doesn't own all the cell towers their customers use. They buy bulk access to the major carriers' networks at a wholesale rate, and then they turn around and sell that access to consumers at a retail price under the Boost Mobile brand.
So their profit margin is just the tiny sliver between the wholesale cost they pay to AT&T or T-Mobile and whatever discount price they can charge a consumer who is likely very price sensitive.
Exactly. It is a volume game. You have to acquire massive amounts of subscribers cheaply, keep them from churning to another discount carrier, and manage your wholesale costs perfectly. And Ergen is admitting that for 4 years, they have failed to grow that volume. They are stuck.
But immediately after admitting they are stuck, he pivoted to the future. He mentioned they brought in new leadership, a guy named Bob Rucinski, about 4 or 5 months ago. And Ergen claimed they have strategic initiatives going forward that will reinvigorate that part of the business.
We have to translate the corporate speak here.
Right. When a CEO says, "We've treaded water for 4 years, but we've brought in new leadership and strategic initiatives," the translation is, "Our legacy strategy was a catastrophic failure. We fired the executives responsible for it, and we're throwing a desperate Hail Mary with this new guy to see if he can stop the bleeding before we have to pull the plug entirely."
That is a harsh but entirely accurate assessment. Ergen is putting Boost Mobile on notice. He stated plainly on the call that all of EchoStar's businesses must run at a profit long term, and they must have a right to exist.
That is a thinly veiled threat to the division.
Yep. He likes the idea of having a footprint in consumer mobility, but his patience has clearly run out.
And he hinted heavily at maintaining flexibility. He mentioned they have contractual flexibility regarding M&A mergers and acquisitions or strategic partnerships in the wireless space.
Right.
This tells me that if Bob Rucinski and his new strategic initiatives can't fix Boost Mobile quickly, Ergen is entirely open to selling it off to a competitor or finding a partner to absorb the operational risk. He will not let it drain that $15 billion cash pile.
If you step back and look at the broader picture, EchoStar is essentially in the middle of a messy, protracted, and incredibly expensive divorce from its legacy telecom infrastructure.
Exactly.
The FCC is forcing them to tear down physical networks. They're bleeding subscribers at Boost Mobile. The Hughes subsidiary is actively fighting bondholders in Chapter 11 bankruptcy court.
And to make matters worse, they can't even execute these structural changes quickly because they're bogged down in litigation.
The litigation is a nightmare.
Let's look at the sheer frustration Ergen voiced regarding the court system. Analyst Mark Dunbar asked a fairly standard question about their ability to access capital markets given all the lawsuits flying around over the past year.
Right.
Ergen immediately dismissed the premise, saying they don't need capital markets because of the $15 billion cash pile. But then he went off on this fascinating tangent about the physical tower companies.
And this tangent was incredibly revealing about the reality of how business actually gets done at the highest levels and how the legal system actively hinders it.
Ergen was furious. He said the major tower companies, these are the real estate entities that actually own the physical steel towers that hold the antennas, made a massive amount of money off EchoStar over the years. But because EchoStar is shutting down networks, they are trying to break or alter long-term master lease agreements.
Breaking a 10-year lease on a cell tower is not like breaking a lease on an apartment.
No.
These contracts are ironclad, representing billions in guaranteed revenue for the tower companies. They don't just let you walk away because the FCC told you to shut down your network.
And that resulted in lawsuits. But listen to Ergen's specific quote about this because it just drips with contempt. He said, "It's unfortunate that particularly the tower companies instituted litigation because it stopped the communication. Lawyers make money by litigating. They have no incentive to try to get clients together."
It is the ultimate lament of an old-school corporate operator. Charlie Ergen is a negotiator.
Right.
He's used to flying to a city, sitting across a mahogany table from another CEO, sliding a piece of paper across the desk, and hammering out a deal that works for both sides. He views business as a direct negotiation between rational actors.
But the moment the tower companies filed lawsuits, that direct line of communication was severed.
Exactly. Corporate legal counsel immediately steps in and says, do not speak to the other CEO. All communication must go through the legal teams. And as Ergen correctly points out, the incentive structure for external law firms is based on billable hours. The longer the litigation drags on, the more motions they file, the more discovery they demand, the more money the lawyers make. They are financially disincentivized from a quick, rational settlement.
Which brings us to the most brilliant, albeit cynical, strategy we've uncovered. Because the two CEOs couldn't just negotiate, Ergen pointed out that they are now forced to use a third party, specifically a bankruptcy judge, to make the decisions for them.
This is a crucial insight for the listener. When EchoStar utilizes bankruptcy courts for subsidiaries like Dish Wireless or Hughes, it isn't necessarily a sign that the parent company is out of money.
It's a tactical maneuver to bypass the litigation gridlock.
Precisely. He is using the federal bankruptcy court as a highly accelerated, legally binding arbitration system.
That's crazy.
Ergen explicitly noted on the call that one side or the other may not like the ultimate decision the bankruptcy judge makes. It might not be the optimal deal they could have struck in a boardroom. But a bankruptcy judge has the ultimate federal authority to cram down a resolution, break the leases, assign the losses, and force an outcome. It ends the billable hours and gives Ergen finality, even if the process takes months.
So if we summarize this entire operational nightmare, EchoStar is staring down a massive $5 to $7 billion tax and FCC shutdown liability. They are struggling to keep a floundering retail wireless brand afloat in a vicious market. And they're using bankruptcy courts as a blunt instrument to break lease agreements with uncooperative tower vendors who are hiding behind expensive lawyers.
It sounds incredibly bleak when you list it out like that.
It really does.
But you have to remember the counterweight. The golden goose, the 261.8 million shares of SpaceX and the $15 billion in cash is sitting right there on the balance sheet, provided the ultimate financial backstop. It is keeping the entire enterprise solvent while Ergen fights these ugly trench wars.
And that understanding is critical. But as a retail investor, you don't make money by simply understanding a company's present struggles.
Right, you have to look ahead.
You only make money if you correctly anticipate what management plans to do with those assets in the future. Which brings us to the core tension of this earnings call. We need to talk about management guidance and why Charlie Ergen is flat out refusing to give Wall Street what it wants.
The tension on this call was palpable. It felt less like a financial presentation and more like an ideological standoff between institutional analysts and a deeply stubborn chairman.
The standoff was entirely about capital allocation, specifically stock buybacks. Let's look at the setup, because the analysts thought they had Ergen cornered with logic.
They really tried.
Analyst David Barden took the floor and pointed out something that everyone knows to be true. EchoStar stock trades at a massive, undeniable discount relative to its net asset value, or NAV. Barden essentially asked, you have the cash from the AT&T deal, you just authorized a $5 billion buyback program, your stock is dirt cheap, why aren't you buying it?
It is the most logical, fundamentally sound question you can ask in traditional corporate finance. Net asset value is a simple concept. If you sold off every asset the company owns tomorrow, the cash, the spectrum, the SpaceX shares, paid off all the debt, and distributed the remainder to the shareholders, how much would each share be worth?
And Barden is pointing out that the current stock price in the open market is drastically lower than that underlying liquidation value.
Right. So the standard Wall Street playbook dictates that if your stock is trading at a severe discount to NAV and you have billions in excess cash, the absolutely best, lowest risk investment you can make is to buy your own stock.
Because it shrinks the number of outstanding shares.
Exactly, which mathematically increases the value of every remaining share, and you unlock that trapped value for the investors. It's a guaranteed win.
But Ergen refuses to commit. He acknowledges the mathematics. He says, yes, the board increased the authorization to $5 billion, and it's obviously one of the things we look at. But then he explicitly ranks his capital priorities, and buybacks are dead last.
Dead last.
He lists priority number 1, invest in the existing core businesses. Priority number 2, look for outside strategic opportunities via EchoStar Capital, which is their internal venture arm now led by Tom Collin.
Right.
And then way down at the bottom of the list, almost as an afterthought, he says, after that, if we can't find anything there, then you get work all the way down to paying dividends or executing stock buybacks.
This is vintage Charlie Ergen. He fundamentally views himself as a steward of long-term capital and an operator of businesses. He does not view himself as a financial engineer whose job is to manufacture a quick 15% bump in the stock price for the benefit of hedge funds who want to trade the momentum.
Okay, I understand the philosophy, I really do. But I have to push back here because later in the call, analyst Sebastiano Petty follows up and asks the exact same thing. Why increase the buyback ceiling from $2 billion to $3 billion all the way to $5 billion if you are going to remain totally out of the market?
Yeah, it's a fair question.
And Ergen just mumbles something about restrictions in their bond indentures limiting exactly when and how they can buy, but he doesn't lean on that as the real excuse.
No, the bond indentures are a minor technical hurdle. He leans heavily on his macro worldview.
And it drives the analysts crazy. Towards the end of the call, analyst Brian Kraft basically throws his hands up in sheer frustration.
I remember that part.
Kraft gets on the line and says, it sounds like you don't have any real plan to buy back stock, even though your stock is trading at like a 50% discount to NAV. I think we're all kind of struggling to understand what the real message is here.
He spoke for everyone on that call.
If I'm a retail investor listening to this call in my car or whatever, I'm screaming this exact same question. I'm looking at a 50% discount to NAV. I know he has $15 billion sitting in a bank account. This makes zero sense. If management truly believes their company is going to survive, isn't buying your own stock at a 50% discount the most conservative guaranteed return you can possibly get? Why hoard $15 billion while your shareholders suffer?
It is a fantastic, completely justified rant. And to understand why he's doing this, we have to unpack Ergen's specific poker player mentality, which he explicitly referenced on the call, and combine it with a terrifying realization he had about the future of his company.
Oh, this is the good stuff.
Let's start with his view of the macro market. Ergen described the current economic environment as fraught and pretty frothy. He noted that asset prices are at historical highs on almost every metric.
When a billionaire who has spent 40 years buying and selling telecom assets calls a market frothy, he is saying that everything is wildly overpriced.
Exactly. He is saying, I am sitting on $15 billion, but every single company, spectrum license, or startup I look at acquiring is trading at a ridiculous multiple. He explicitly told the analysts that EchoStar will not rush out and overpay for an asset just because the money is burning a hole in their pocket.
And that's when he used the poker analogy. He said, I can only tell you from playing poker, you can win a few big hands and you're still going to bet the same way, right? I'm playing the odds and it's pretty frothy right now, so we probably are more cautious.
It's a brilliant insight into his discipline. EchoStar just won a massive hand at the poker table. They hit the jackpot on the SpaceX appreciation, and they cashed in a massive chip with the AT&T transaction.
Right, they're the richest player at the table.
But Ergen is refusing to let that newfound wealth change his deeply ingrained, disciplined, value investing approach. He is playing tight, defensive poker, waiting for the market to crash so he can buy assets on the cheap.
Okay, that explains why he won't buy other companies. But it still doesn't answer the core question of why he won't buy his own stock, which he openly admits is severely underpriced. If the rest of the market is frothy, but your stock is cheap, buy your stock.
And that is where we get to the massive reveal. The real reason he is hoarding the cash is because of the impending transition costs of a structural pivot he never saw coming.
The artificial intelligence pivot.
Yes. This was the absolute bombshell moment of the earnings call, and I feel like the analysts completely glossed over it because they were so angry about the buybacks.
They totally missed it.
Ergen admitted that restructuring the company's debt and fixing Boost Mobile is one thing, but they are also facing an existential technological threat.
He was brutally honest. He said, verbatim, our company wasn't built for AI. We didn't know anything about it years ago.
Just pause and think about the gravity of that statement. You have the chairman of a major global telecommunications and technology holding company publicly admitting that they were entirely, 100% unprepared for the biggest technological paradigm shift of the last 2 decades.
It's wild. He went on to say that they have to pivot immediately and that in a funny sort of way, there's restructuring going on within EchoStar to say, how do we take advantage of that? He admitted that the company's future success will be entirely dependent on how well they adapt to AI, and that it is way too early to tell how they're actually going to do it.
So put the pieces together. What does an AI pivot actually look like for a legacy telecom and satellite company? It isn't just buying some software licenses.
No.
It means retrofitting physical networks to handle massive increases in data throughput. It means investing in data center infrastructure, edge computing, and specialized server cooling technology. It means completely redesigning how their networks route traffic.
Which requires billions and billions of dollars in capital expenditure.
Precisely. That is the answer to your frustration. Why is Ergen hoarding $15 billion and refusing to buy back stock at a 50% discount? Because he knows that retrofitting a legacy satellite and wireless company to survive an AI-driven future is going to require immense amounts of physical capital.
Wow.
He cannot afford to burn $5 billion on stock buybacks today to appease a few hedge funds if he suddenly needs $10 billion next year to build out an AI-capable infrastructure just to keep the company from going bankrupt.
The cash is his insurance policy against technological obsolescence.
Exactly. The buyback authorization is just a tool to keep the market from shorting the stock to zero. It's a deterrent. But the cash is reserved for survival.
It is incredibly frustrating if you are a short-term shareholder who just wanted a quick pop in the stock price. But if you look at it through the lens of a decade-long survival strategy, it is the only logical move. He is keeping his powder dry for an existential war.
And this cautious, long-term philosophy extends to how they are handling their other major assets, specifically their unbuilt spectrum.
Let's transition to that because spectrum is another massive pile of trapped value on this balance sheet. Analyst Michael Rollins asked about the status of their remaining spectrum licenses, specifically the AWS3, CBRS, and 700 megahertz bands.
Right.
We touched on spectrum earlier when discussing the FCC, but we need to explain what these specific bands mean. Spectrum is essentially invisible real estate in the sky, right?
It is. It's the physical radio frequencies that carry wireless data from a cell tower to your phone. And different bands have different physical properties.
Okay, give me an example.
The 700 megahertz band, for example, is highly coveted because lower frequencies travel further distances and penetrate concrete buildings much better than high frequencies. CBRS and AWS3 are mid-band frequencies, which offer a great balance of speed and capacity.
So EchoStar owns the exclusive rights to broadcast on these specific, highly valuable frequencies in certain geographic areas, but they have a massive problem. As we discussed, they are actively shutting down their physical wireless network.
Which puts them in direct violation of the fundamental rule of spectrum ownership. The FCC doesn't just auction off a frequency and let you sit on it forever as an investment.
Right.
They sell it with a ticking clock attached. It's called a build-out requirement. They mandate that you must build actual cell towers and utilize that spectrum to serve the public by a specific date. There are anti-hoarding rules. If you don't build it, the government confiscates the license.
But Jeff Blum, EchoStar's acting chief legal officer, stepped in on the call to address this. He confirmed that the FCC chairman previously agreed that EchoStar had met its initial build-out commitments, so they aren't in immediate default.
Okay, that's good.
However, Blum noted they have now officially filed for a waiver from the FCC regarding the final build-out requirements for these remaining licenses.
And the explicit purpose of this waiver request is crucial for investors to understand.
Yes. Blum stated they filed the waiver so they can sell those for fair value in exchange for the FCC granting an extension on the build-out timeline. Blum argued that since EchoStar no longer has a network to integrate this spectrum into, it makes logical sense for the FCC to grant the waiver and allow them to sell it.
This is a massive potential catalyst hiding in plain sight. If the FCC grants that waiver, EchoStar is suddenly legally free to auction off this highly valuable AWS3, CBRS, and 700 megahertz spectrum to the highest bidder.
Which would presumably be AT&T, Verizon, or T-Mobile, who are always desperate for more capacity.
Exactly. They could instantly monetize billions of dollars of invisible real estate without having to spend a single dime building cell towers they don't want anymore. It's a pure value realization.
It is. But once again, they are entirely at the mercy of the government's timeline. They're playing a waiting game with the FCC, just like they are playing a long-term waiting game with potential corporate consolidation, specifically regarding DirecTV.
Yes. Analyst Brian Kraft brought up the long-rumored DBS consolidation. DBS stands for Direct Broadcast Satellite. Essentially, Wall Street has been waiting for years for EchoStar to merge its legacy DSH satellite television business with its massive rival, DirecTV.
It is the most obvious merger in the history of telecommunications. Both companies are operating legacy, declining satellite television businesses in an era of high-speed fiber internet and streaming.
Ergen's response to this was classic. He didn't deny it. He said he has always believed it is inevitable that the two companies will be put together.
Right.
But he admitted that by waiting this long, they've probably squandered some opportunity. He noted that the financial synergies, the cost savings from firing duplicate staff and combining operations, aren't as high today as they would have been 5 years ago, simply because both businesses are much smaller now.
But he insists those synergies still exist.
Yes. And what is fascinating here is his complete lack of corporate ego regarding how a deal would be structured.
It's true. He said they have no preconceived notions about whether EchoStar would be the buyer, whether they would be the seller, or if it would be some sort of joint venture. The only question that matters to him is finding the right mathematical value for his shareholders.
He also noted that in the meantime, they are continuing to invest in the dish business for the long term, focusing on retaining high-value customer relationships. He explicitly admitted that this strategy hurts their short-term EBITDA numbers.
Wait, define EBITDA quickly for the retail listener, because analysts obsess over it.
Oh, sure. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a rough measure of a company's core operational cash flow. Wall Street analysts love it because it strips out the messy accounting and shows how much cash the daily business is generating.
And Ergen is basically saying, I know investing in customer service lowers my EBITDA this quarter, and I know that makes your spreadsheet look bad, but it makes the business stronger for whenever we finally merge with DirecTV.
Again, he is prioritizing long-term structural value over the short-term financial metrics that Wall Street demands.
It is a consistent theme across the entire call.
Truly.
And finally, regarding the timeline of when we might see some resolution to this massive web of complexity, we did get one hard date. We talked about the Hughes bankruptcy earlier, but EchoStar also has the Dish Wireless entity in a separate bankruptcy proceeding.
Right.
Ergen stated that the confirmation hearing for Dish Wireless is set for October 13th, and he expects that specific bankruptcy to be entirely wrapped up in the fourth quarter of this year.
So investors finally have a calendar date to circle in red marker. By the fourth quarter, the Dish Wireless chapter should legally close, which will remove a significant layer of opacity from the overall corporate structure.
All right, we have covered an immense amount of ground. We have dissected the contradictory cash and debt numbers, the bizarre Hughes bankruptcy, the 1033 tax exchange strategy for the SpaceX windfall, the struggles at Boost Mobile, the tower lease litigation, Ergen's refusal to buy back stock due to the AI pivot, and the pending FCC spectrum waivers.
It's a lot to process.
It is. Now, it is time to bring all of this complex data together and formulate a definitive, actionable thesis. We are moving to the final stage of our analysis. The bottom line, what does this actually mean for you, the retail investor?
This is where we have to distill all of Charlie Ergen's poker analogies, legal firewalls, and macro philosophies into a concrete strategy.
And we don't do wishy-washy summaries here. We take a position. So I'm going to break this final analysis into two distinct parts. My view on the underlying asset value of the company and my view on the near-term catalysts for the stock price.
Okay, let's hear it.
Let's start with asset value. I am taking an extremely bullish stance here.
Yeah.
The sheer mathematics of this balance sheet are undeniable, even with the operational struggles. When you stack up $14 to $15 billion in cash, Add the unrealized multi-billion-dollar value of the AWS3 and CBRS spectrum waiting on that FCC waiver, and then pile on the gargantuan, undeniable implied value of 261.8 million shares of SpaceX.
Huge.
And you weigh all of that against a highly managed, ring-fenced debt profile. On pure mathematical paper, EchoStar looks wildly undervalued.
It is genuinely hard to argue with the arithmetic of the assets. As Ergen himself pointed out to the frustrated analysts, you can go online and publicly figure out the implied value of the SpaceX shares based on recent funding rounds.
Right.
You can look at recent spectrum auctions to take an educated stab at the value of their frequencies. And the cash is sitting right there in the bank. It is a certified treasure chest of high-value assets.
However, when we pivot our analysis to the near-term catalysts, meaning what is going to make the stock price go up in the next 3 to 6 months, I have to take a deeply bearish stance.
And that is the critical defining paradox of EchoStar right now. The assets are brilliant, but the timeline to realize them is brutal.
Management spent this entire earnings call explicitly, repeatedly telling Wall Street not to expect quick, shareholder-friendly actions. Ergen practically dared the analysts to be frustrated with him.
He really did.
He said, and this might be my favorite quote of the entire call, "I don't think we fit into the normal box of professional management, multiple of EBITDA, come to conferences and talk about how great you're going to do and do unhealthy long-term things to make a particular number."
He's just calling them out.
He is flat out telling the market, "We will not authorize a quick buyback to juice the stock price. We will not rush into a frothy M&A market to buy growth. And we will not artificially pad our short-term EBITDA just to make your quarterly models look good."
This specific dynamic is a textbook example of a phenomenon known in finance as the conglomerate discount. And Ergen is so self-aware that he actually referenced it himself on the call.
Let's unpack that because it's vital for understanding the stock price. What exactly is a conglomerate discount?
When a holding company or a large conglomerate owns a bunch of disparate, highly valuable assets, say a satellite TV business, a retail wireless brand, a massive cash pile, and an equity stake in a private space company, the public stock market almost never values the parent company at the full 100% sum of its parts.
Why not? If I have a $10 bill, a $20 bill, and a $50 bill in my wallet is worth $80. Why does the stock market say it's only worth $40?
Because of the lack of confidence in management's willingness or structural ability to actually unlock that value and hand it back to the shareholders in a reasonable time frame, the market applies a severe discount rate to the stock price based on how trapped they feel the capital is.
Ah, I see.
If investors know that Charlie Ergen is going to hoard $15 billion for the next 5 years to fund an unknown AI transition, and that he's perfectly willing to drag subsidiaries through years of messy bankruptcy litigation, they penalize the stock.
Yeah.
Ergen is essentially looking at Wall Street and saying, "I know you are applying a 50% conglomerate discount to my stock because I won't execute buybacks today. I do not care. I am playing a 10-year game for the survival of the enterprise, and you are playing a 3-month game for a quarterly bonus."
Captain Obvious, as he jokingly called it, when responding to Brian Kraft's sheer frustration about the NAV discount. Ergen knows the stock is cheap. He just prioritizes the flexibility of having a fortress balance sheet to navigate an existential AI restructuring over giving shareholders a 20% pop on a random Tuesday.
So if we translate this massive web of complexity into actionable advice for you, the retail investor, your strategy deeply, fundamentally depends on your timeline and your personal risk tolerance.
Exactly. Let's talk directly to the current holders first. If you already have Echo stock sitting in your brokerage account, you need to cultivate immense, practically superhuman patience.
Truly.
You have to realize that you are no longer holding a traditional, predictable, dividend-paying telecommunications stock.
You are holding a highly distressed, aggressively managed, complex financial vehicle.
You are placing a direct, multi-year bet on Charlie Ergen and his army of corporate lawyers. You are betting on their ability to navigate the brutal trench warfare of bankruptcy courts with the Hughes and Dis-H wireless entities. You're betting on their ability to successfully execute incredibly complex tax maneuvers like those Stand 33 exchanges to shield the massive SpaceX windfall from the IRS.
And you are betting on Ergen's ironclad discipline to wait out a frothy market without making a catastrophic acquisition.
Exactly. If you cannot stomach years of messy legal headlines and zero instant gratification, this is an incredibly tough stock to hold.
And for prospective buyers, the value investors out there who are looking at that 50% discount to net asset value and licking their chops, our advice is equally cautious. Do not buy this stock expecting a sudden meme stock short squeeze. Do not buy it expecting a quick algorithmic pop just because you saw a headline that they authorized a $5 billion buyback program.
Read the fine print. An authorization is absolutely not a mandate to purchase.
Exactly. Management is intentionally keeping that money locked up for rainy days, for structural pivots into AI architecture, and as leverage against their hostile creditors.
Right.
Buying EchoStar today is buying a deep value distressed asset play that just happens to have a winning lottery ticket in its back pocket with the SpaceX equity. But you have absolutely no idea what year management will finally decide to cash that ticket.
It is the ultimate grueling test of value investing versus momentum investing. Which brings us to the end of our deep dive into the source material.
It's been quite the ride.
Thank you for joining us on this incredibly dense, complex breakdown of EchoStar's Q2 2026 earnings call. We hope we've helped translate the murky, aggressive waters of corporate finance into something you can actually use to build your thesis.
It is a truly fascinating case study in corporate survival, legal strategy, and ruthless capital allocation.
It really is. But before we sign off, I want to leave you with a final provocative thought, something we haven't explicitly stated yet, but something you need to mull over on your own.
Let's hear it.
Think back to how we started this deep dive. We talked about looking for precision, looking for that clean, binary X-ray of a telecommunications company's health. We try to categorize EchoStar based on its legacy businesses.
Right.
But look at the reality of what we just uncovered. If EchoStar is actively tearing down its wireless network under FCC mandates, if the chairman has explicitly admitted defeat in growing the Boost Mobile retail brand after 4 years of treading water, and if its legacy satellite television business is just slowly bleeding subscribers while throwing off cash in a desperate wait for a DirecTV merger.
Where does that leave them?
If you strip all of that away, EchoStar is essentially just a legal holding company. It is a corporate wrapper for a $15 billion mountain of cash, some dormant spectrum waiting to be sold off via an FCC waiver, and a gargantuan multi-billion-dollar equity stake in SpaceX.
Which leads to a wild conceptual shift.
Should retail investors stop analyzing EchoStar as a telecommunications company entirely? Is it time to rip up the old category labels, throw away the telecom metrics, and start treating the Echo ticker purely as a publicly traded backdoor proxy ETF to invest in the private behemoth that is SpaceX?
That's a great question.
If Charlie Ergen is hoarding the cash for the long haul and letting his legacy businesses slowly decay or merge, maybe you aren't investing in EchoStar's past as a satellite provider. Maybe you're just using his fortress balance sheet to buy a discounted ticket to Mars. Think about that. We'll see you on the next deep dive.